Silver premiums just hit 40%, not on rare collectible coins, not on limited mintage special editions. On basic 1-ounce silver eagles. The most common silver coin in America now costs 40% more than the spot price says it should. Spot says $32. The coin in your hand costs $45. That $13 gap is not a fee. It's not a markup. It's the physical market telling you something the paper market refuses to admit, and almost nobody is listening. Before I show you what's really behind this, I want to know something. Drop a comment right now, one word. Would you pay a 40% premium for physical silver, yes or no? Don't think about it too hard. Just gut reaction, yes or no. Go. All right. By the end of this video, you're probably going to want to revisit that answer, because what you think the premium means and what it actually means are two completely different things. Most people look at a 40% premium and see a problem. They see an overcharge, a reason to wait, a reason to buy paper instead. They think the smart move is to sit on the sidelines until premiums come back to normal. But here's what those people are missing. What if the premium is normal now? What if $32 spot is the anomaly and $45 physical is the real price? What if the gap isn't a temporary glitch, but the market fracturing into two separate realities, one made of paper and one made of metal? That's not speculation. That's what the data shows. And I'm going to prove it. I've been tracking the spread between spot price and physical dealer prices for over 8 years. Every major dealer, every product category, every week without exception. And what I'm seeing right now is structurally different from anything in the last decade. This isn't a supply chain hiccup. This isn't pandemic disruption. This is the beginning of a permanent divergence between paper silver and physical silver. And understanding why tells you everything about where this market is heading. Here's what I'll cover in the next 10 minutes. First, the three mechanical forces driving premiums to 40% and why none of them are temporary. Second, what happened the two previous times premiums hit this level and what the spot price did within 12 months. Third, what the premium is actually telling you about the real value of silver versus the fictional price on your futures screen. Everything comes from US Mint sales data, COMEX vault reports, dealer wholesale pricing surveys, and Silver Institute supply demand reports. Links in the description. Verify everything yourself. Let's get into the mechanics. And I want to track the evidence as we go because by the end the case is airtight. Force number 1, there isn't enough silver being mined to satisfy demand, period. Total global silver mine production in 2024 was approximately 820 million ounces. Total global silver demand exceeded 1.2 billion ounces. That's a 380 million ounce deficit. Not a small shortfall, not a rounding error. A structural gap equal to nearly half of total mine production. Where's the extra silver coming from to fill that gap? Recycling covers roughly 180 million ounces. The remaining 200 million ounces comes from existing inventories being drawn down, vaults draining, stockpiles shrinking, metal that was sitting in storage being pulled out and consumed. When the gap between supply and demand is filled by draining existing inventory, that's not a functioning market. That's a countdown. Every ounce pulled from inventory to meet demand is an ounce that can never fill that role again, because once silver goes into a solar panel, it doesn't come back. It's consumed, destroyed, gone permanently. The premium at your dealer is the first visible symptom of this countdown reaching retail markets. Industrial buyers get served first because they sign long-term contracts at guaranteed volumes. The mint gets served second. Retail investors get whatever's left, and what's left is shrinking every quarter. Evidence point 1, structural deficit draining. Existing inventory to fill demand, not temporary, accelerating. Force number 2, solar demand alone is rewriting the supply equation. 5 years ago, solar panels consumed approximately 50 million ounces of silver annually. In 2024, that number hit 185 million ounces. That's a 270% increase in 5 years. And every credible energy forecast projects continued acceleration through 2030. Think about what that means mathematically. If solar demand alone grows another 50% over the next 5 years, which is conservative, given current installation trends, that's an additional 90 million ounces of annual demand, hitting a supply chain that's already 380 million ounces short. And here's the part that eliminates the substitution argument before anyone raises it. Every major solar manufacturer who has attempted to reduce silver content per cell has reported efficiency losses that make the economics worse, not better. The industry is actually moving toward higher silver content per panel with next-generation heterojunction cells. Silver isn't being designed out of solar. It's being designed deeper in. New silver mines take 12 to 17 years from discovery to production. There are 0 major new silver mine projects scheduled to begin meaningful production before 2028. The supply response that would bring premiums down doesn't exist, and the timeline for it to exist stretches past 2030. Evidence point 2, solar demand exploding with no substitution possible and no new supply coming. The industrial squeeze on available silver is permanent. Force number 3, COMEX is running out of deliverable silver. As of the latest Vault report, COMEX registered, silver stands at roughly 107 million ounces. Open interest represents approximately 760 million ounces of paper claims. That's a 14% coverage ratio. For every ounce of real silver in the vault, there are 7 paper claims against it. 3 years ago, registered inventory was above 150 million ounces. It has been declining steadily quarter after quarter without reversal. Metal is leaving the COMEX system faster than it's entering. And the metal that's leaving isn't going to jewelry stores or coin dealers. The delivery data suggests it's being absorbed by industrial users and large institutional accumulators who want the metal, not the paper claim. When COMEX inventory drops, the wholesale market tightens. When wholesale tightens, dealers pay more to source product. When dealers pay more, you pay more. The 40% premium at your local coin shop is the surface level manifestation of a drainage happening in vaults most people will never visit or even think about. Evidence point 3, COMEX vaults draining with no reversal in sight. Paper claims exceeding physical backing by 7 to 1. 3 forces, all structural, all ongoing, all accelerating. The premium isn't a temporary inconvenience. It's the physical market repricing silver in real time, while the paper market pretends nothing has changed. Think of it this way. The spot price is the landlord telling you the rent is $1,000. The premium is every apartment in the building actually renting for $140 to $100 because there aren't enough units for everyone who wants one. The listed price means nothing when the transaction price tells a different story. The transaction is the truth, the listing is the fiction. Now let me show you what happened the 2 previous times premiums reached anywhere near this level. Because the pattern afterwards is consistent, and it matters right now. March 2020, COVID shuts down mints and refineries worldwide. Physical silver becomes almost impossible to buy at any price. Premiums on Silver Eagles spike to 50 to 100% above spot. Spot crashes to $12 per ounce, but the cheapest physical silver available sells for $25 to $30. 2 separate markets emerged overnight. The paper market said silver was worth $12. The physical market said it was worth $25. They couldn't both be right. The resolution took 12 months. Spot silver rallied from $12 to $30 by February 2021. A 150% increase. The paper price climbed until it reached the level where physical had already been trading. The physical market was right. The paper market was wrong. The premium told you that months before the spot chart confirmed it. And here's the detail most people forget. The people who waited for premiums to normalize before buying never got silver at $12. Premiums stayed elevated for months. By the time premiums dropped to reasonable levels, spot was already at $22 to $25. The total cost of waiting was higher than the total cost of paying the premium and buying immediately. February 2021. The Wall Street silver movement triggers a retail buying surge. Every major online dealer sells out within 72 hours. Premiums spike to 40 to 60% on Silver Eagles. Spot is $27. Physical is selling for $38 to $42. Again, 2 separate markets. Paper says $27. Physical says $40. The paper market called it a speculative frenzy. The physical market called it a shortage. The premium told you which one was true. Spot silver never returned to the $20 level it traded at before the squeeze. The people who waited for premiums to normalize and prices to drop back to $22 are still waiting 4 years later. The premium was the signal. The signal was right. 2 events, same pattern both times. Premium spikes above 30%. Paper price eventually rises toward where physical was already trading. People who paid the premium got metal and gains. People who waited for cheaper prices got neither. Here's what I want you to ask yourself honestly. If every previous premium spike of this magnitude preceded a significant rise in the spot price, are you really saving money by waiting? Or are you paying for the illusion of saving money while the real price moves further away from you? That question answers itself. And this time the setup is actually more significant than both 2020 and 2021. In 2020, the premium spike was caused by a temporary supply disruption. Mints closed. When they reopened, supply resumed and premiums gradually normalized over 6 months. The cause was temporary. The premium was temporary. In 2021, the spike was caused by a demand surge driven by social media momentum. The momentum faded. Premiums normalized over 3 to 4 months. The cause was temporary. The premium was temporary. In 2025, the premium spike is caused by a structural supply deficit of 380 million ounces annually, by solar demand that grew 270% in 5 years and is still accelerating, by COMEX inventory at historic lows and draining, by a mine supply pipeline that has 0 major new projects coming online before 2028. None of these causes are temporary. None of them are fading. The premium isn't a spike, it's a repricing. Quick pause. If you've made it this far, you understand what silver premiums actually mean better than 95% of precious metals investors. Most people see the premium and get angry at their dealer. You now see the premium as the most important data point in the entire silver market. It's the physical market's price discovery mechanism operating independently from a paper market that's running out of metal. The premium isn't a cost, it's a forecast. But here's the thing. If these structural drivers continue and every available data point says they will, the gap between paper and physical will widen before it resolves. History shows it always resolves the same way. Paper rises to meet physical, not the other way around. Next week, I'm breaking down the COMEX delivery data from the last 90 days, showing which entities are pulling metal out of the vault system and why the drain is accelerating. Subscribe. Hit the bell. That video explains where the metal is going and who's taking it. Now I know what some of you are thinking. Just wait. Premiums always come down. Every spike normalizes eventually. I'll buy when premiums are back to 10% and save myself 30%. Here's the math on that strategy. In 2020, premiums normalized, but spot went from $12 to $30. You saved 50% on the premium, but missed a 150% move. In 2021, premiums normalized, but spot held above $25. You saved 20% on the premium, but lost the chance to buy below $25 permanently. In both cases, the total cost of buying later at lower premiums was higher than the total cost of buying immediately at elevated premiums. The premium savings were a mirage that cost more than they saved. And there's a second objection. Why not just buy paper silver through SLV or futures and avoid the premium entirely? Because the premium exists specifically to tell you that paper and physical are not the same thing right now. A 40% gap between the paper price and the physical price is the market itself screaming that paper claims are worth less than metal in hand. Buying paper to avoid that gap is choosing the product the market is explicitly telling you is less valuable. When the gap is 2 to 3%, paper and physical are essentially interchangeable. When the gap is 40%, they are fundamentally different assets with fundamentally different risk profiles. 3 things you can do this week, easiest to hardest. Step 1 takes 30 seconds. Check premiums across 3 different dealers right now. Apimex, SD Bullion, JM Bullion. Calculate the percentage above spot for a basic Silver Eagle, a generic round, and a 10-ounce bar. Notice the difference between product types. Government coins carry the highest premiums. Generic rounds carry less. Bars carry the least. If you want physical exposure, at lower premiums, bars are your most efficient entry point. Step 2 takes 10 minutes. Set up a premium tracking spreadsheet. Record the premium on one product from one dealer every week. Over 4 to 6 weeks, you'll see whether premiums are expanding, contracting, or holding steady. Expanding premiums mean the shortage is deepening. This is free data that tells you more about real silver supply and demand than any analyst report. Step 3 requires a decision. If you've been waiting for premiums to normalize, look at the 3 structural forces driving them and ask yourself honestly when you expect them to reverse. When will the 380 million ounce deficit close? When will solar demand stop growing? When will COMEX vaults refill? If you can't answer those questions, the premium isn't going back to normal, and the total cost of buying is going up every month you wait. Remember, at the beginning, when I asked if you'd pay a 40% premium? Now you've seen what the premium actually represents, not a markup, a measurement. A measurement of the gap between what paper says silver is worth and what the physical market actually charges when real metal changes hands. If you want to change your answer, the comment section is right there. So let's land this. Silver premiums hit 40% above spot. 3 structural forces are driving it. A 380 million ounce annual supply deficit filling the gap by draining existing inventory. Solar demand that grew 270% in 5 years, with no substitution and no new supply pipeline. COMEX registered inventory at 107 million ounces and declining steadily. 2 previous premium spikes of this magnitude both preceded significant spot price rallies. Both times, the people who paid the premium and bought immediately outperformed the people who waited. The premium isn't a cost to avoid, it's a signal to read. One more thing before I go. While tracking wholesale premiums this week, I noticed something that hasn't happened before. The premium on 1,000-ounce industrial bars, which normally trade within 1% of spot, just jumped to 4 to 5% above spot. These are the bars that feed the COMEX delivery system and the industrial supply chain. When wholesale premiums spike, the retail premium expansion that follows is historically 3 to 5 times larger. If wholesale bars are now 5% over spot, retail premiums of 50 to 60% are not unrealistic within the next few months. I'm tracking wholesale data daily. When I have a complete data set, that's the next video. The spot price says $32. Your dealer says $45. The solar industry says 185 million ounces and growing. The COMEX vault says 107 million ounces and shrinking. The wholesale market just started confirming what retail has been screaming for months. Every level of the supply chain is now telling you the same thing. The paper price is a fiction. The premium is the correction. Most people just haven't walked into a dealer yet to see it for themselves. See you in the next one.